Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we're working on the Chapter 3 theory videos for the chapter Adjusting and Closing Entries. And just a word of warning, watch video 1 and watch video 2 before you before you watch this third video, because I'm just going to pick up right where I left off, and one flows into the other. Okay, so let me get to where I need to be. All right. Right. Let me go back up here just real quick. Okay. And I'm going to erase some of this. Okay, so where we were at the end of chapter 2, and remember, everything is overlapping here. Okay. Chapter 1 overlapped with chapter 2. Chapter 1 and 2 overlaps with chapter 3, as the way the information is presented in the textbook, or just as the way bookkeeping and accounting actually works. So kind of like where we're at is we had gone through step 1, step 2, and step 3, and a little bit of step 6 as part of chapter 2. Okay, but now in chapter 3, we're going to step beyond that. We're kind of like at the end of the accounting period right now. Okay, and what we're going to do from there. I mean, because let me just redraw this again. And I know I've already written it twice, but this will be a third time. We start out with beginning balances in our ledger accounts at the beginning of an accounting period. And during the accounting period, we have transactions, so we make journal entries. And at the end of the accounting period, we have to make sure that all of those journal entries are posted into the GL accounts, into the general ledger accounts. Once they're posted, now this is where we're kind of like at as far as the work in chapter 3. We're not finished yet, okay, with the accounting process, okay? Because remember, when we finish the end of an accounting, the accounting period, that takes us right back to the beginning, okay? Because the ending balances in our general ledger accounts become the beginning balances for the next accounting period, right? So when we get to the end of the accounting period, we post, but all of the information isn't correct, and we don't have, it's like we're only halfway finished, and the vast majority of work that we have to do for an accounting period, happens at the very end, and that's what we're covering in chapter 3 here. Okay, so let me jump down. Okay, so in chapter 2, the information was presented. Now we're at the end of the accounting period here, okay? And we had posted everything to our general ledger accounts, which allows us to create balances in the accounts and create a trial balance. But notice it doesn't, in chapter 2, it didn't say what kind of trial balance. A trial balance is a tool, and whatever this name is, tells you where you're at in the process, okay? At the end of the accounting period, once we've posted everything into our general ledger accounts, we create an unadjusted trial balance. Okay, and notice that now it's being named. Right? Go back and watch. The thought just popped into my head. We have introductory videos, which has a different way of thinking. Not a different way. It's just presented differently. The process that you go through. In other words. This is an unadjusted trial balance. Well, we're also going to create an adjusted trial balance, and we're also going to create a post-closing trial balance, and that's what this whole chapter is about, is creating basically these 3 trial balances and creating the financial statements from them, all right? But in chapter 2, the trial balance wasn't named. In this chapter, now it is being named. So we're at the end of the accounting period. It's the last day, if let's say it's a monthly accounting period, so we're, last day of the month, we've posted all of our transactions to our general ledger accounts, created the balances in the accounts, and we've created our trial balance. And the reason why we call it unadjusted is because we don't know if these accounts are, if the balances in these accounts are correct. Okay, there's still other work to be done. Okay, there's transactions. Well, one, maybe there's errors, so we have to correct the errors. Maybe there's other transactions that have not gotten on the books because they haven't, there was nothing to trigger creating that transaction. So they're called adjusting entries. Okay, and we also have to create our closing entries. Right? So right now we're looking at an unadjusted trial balance, and this is like the beginning point. These balances are the beginning point for what is called the closing process. Okay. The closing process is how we make sure that our information is absolutely correct in the way we want to present it on our financial statements. Now, we start out with this unadjusted trial balance, and on the slide I'm showing you a worksheet. Okay, actually these next two slides, right? Because I can't fit them all on one page. But these worksheets, you're not going to see these in the textbook. They're not in there. Okay, I took these worksheets out as an example out of our bookkeeping course, the Penn Foster bookkeeping course. And what ends up happening is, you have to imagine, here's the bookkeeper and here's the accountant. Remember, the bookkeeper is working with the computer. Okay, they're the ones who are doing the data entry into the books. Okay, they're putting it in, that information in there. It's up to the accountant to make sure that the information is correct, and then to be able to analyze it and utilize it in whatever way, shape, or form for the business, right? But when it comes to the end of the accounting period, it's up to the accountant to make sure that the information is correct. So what you have here is you have a disconnect. You have one person doing one thing, you have another person doing another thing. And if you're doing the process right, they both check on each other, okay? So that if one makes an error, the other person knows about it, okay? It is possible for you to be both the bookkeeper and the accountant at the same time, all right? One person doing all of the books. And as long as you're kind of like following the process, it works out just fine. And that's the purpose behind the worksheet, okay? Because at the end of the accounting period, the bookkeeper creates the trial balance, the unadjusted trial balance. Unadjusted trial balance. And from that trial balance, on the first two columns of the worksheet, okay, they just repeat the information. Now remember, this here is a paper form, okay? It's handwritten, okay? It's not done in the computer. Creating this here unadjusted trial balance, it's created from the computer. So we're taking that information and putting it on our worksheet, okay? But remember, we don't know if that information is correct or not, and that's why it's unadjusted. Now notice in the next column here, next two columns, on the worksheet, everything is debit, credit, right? In the next two columns, we have adjustments, all right? Well, what these adjustments are, remember, the trial balance, we don't unadjust the trial balance, and notice unadjusted because it's before we make the adjustments. Okay, we don't know if those entries are correct or incorrect. Now, I'm not going to go through all of these here entries, okay, remember, because this comes from a different course, a different program. But I want you to realize is that these are correcting and adjusting entries that are made. And they're done on this worksheet, and the account gives the bookkeeper the entries for the bookkeeper to enter into the computer. So when the bookkeeper enters them into the computer, an adjusted trial balance is created. Why? These are journal entries, and the bookkeeper will enter them just like into the journals, just like they do any other transaction, and those transactions get posted to the ledger accounts, and the ledger accounts new balances are created, and from those new balances we create an adjusted trial balance. Okay, so the adjusted trial balance, again, comes from the computer, right? But we don't know if that information is right or wrong. Okay, right? So what happens is the accountant, what he's doing is, and as you can see, this says adjusted, okay, and it has a debit, right? Well, I'm going to change slides, and here's the other side of it, all right? Adjusted trial balance, and here's the credit side. Okay, so imagine these are 2 pages together. Unfortunately, you wouldn't be able to read them if I put them all on the same slide, so just bear with me. What ends up happening is the account is using this worksheet, and he starts out with the unadjusted trial balance, and then he makes adjustments, and then he does the math, right? He takes the debit plus or minus the credit, and then he puts that amount in the debit column or the credit column, depending upon what that balance is. So for this cash account, it's like 8,590 as a debit. Since there's no debit or credit, that's the adjusted balance. Okay, if you look at here, merchandise inventory, it's 19,700, but then there's a debit for 21,150 and a credit for 19,700. So when I take the debit plus the debit minus the credit, I end up with a debit of 22,150. And so that's now the new balance in that ledger account. So what I'm creating here is I'm taking, and the accountant goes down and he does the math. Basically, he's taking the debits less the credits plus the debits less the credits, and creates a new debit or a credit. And this is the adjusted amounts. Now, the bookkeeper ran an adjusted trial balance from the computer, and the accountant will then take and compare what that adjusted trial balance looks like with those figures from his math on the worksheet. And if there's a mistake somewhere, okay, meaning, let's say here for office supplies inventory, okay, let's say the account says, there should be a balance, a debit of $280, but from the computer printout, let's say there's a debit of $180. Well, we have to know why there's the difference between the two. And since there was a mistake made, maybe the accountant made a mistake in the math. Well, then he corrects it on the worksheet. But if the mistake was made by the bookkeeper entering it into the computer system, well, now we have to make another adjustment, okay, and make that adjusting journal entry, post it to the ledger accounts, create the balances, and then create ourselves a new adjusted trial balance from the computer so that we can match that up and then look at what the accountant has on the worksheet. So it's kind of like circular, right? Here's the bookkeeper's work, here's the accountant's work. The accountant did the math here. The bookkeeper creates the adjusted trial balance, okay? And if the balances don't match, a new adjustment needs to be made. And when the new adjustment is made, the journal entry is made, it's posted, get new balances, and a new adjusted trial balance. So then we can compare that again. And if there's still a mistake, the mistake needs to be corrected until the accountant is absolutely satisfied with, the figures that are in the, in the computer system with what he has on the worksheet. Okay. So once the worksheet, once we have our adjusted trial balance column with the correct balances in them, and again, here there would be I'm doing this across 2 slides, so I have to apologize for that. It's just the nature of how big the worksheet is. There'll be a debit column here, and there'll be balances in these accounts. And once the accountant is absolutely sure that what's in the computer system or what's on the books matches what's on this here worksheet, okay, in the adjusted trial balance column, from these figures he can create the income statement, the balance sheet, and the post-closing trial balance. Okay. without going through all of the absolute steps here, because right at this moment in time, it's not that important. I mean, you're in financial accounting. Realize that this is meant to be teaching accounting and not bookkeeping. But what I want you to realize is that all he's doing is transferring information over. So any of the accounts that affect the income statement are, the revenue and expense accounts are moved over, and you end up with a debit and a credit, which gives you a profit or loss. And of course, since we're using income statement accounts, that means when we transfer over information into the balance sheet, our debits don't equal our credits here. Okay, so we have to take that into consideration as part of the closing process. And in the closing process, what we're doing is we're moving our profit or loss on our income statement over to our balance sheet. Okay, and when we do that, then that brings all of our debits and our credits to equal each other, and we're able to create a post-closing trial balance. Right now, this is being done on a piece of paper, but to close out the income statement accounts to the balance sheet, again, those entries have to be given to the bookkeeper, and the bookkeeper enters it into the computer, right? And a post-closing trial balance is created. Okay, and that post-closing trial balance needs to match what is on the worksheet. And if there's a mistake, it has to go back and be corrected again. Okay, so with all of that said, like I said, you're not seeing this in the book, okay, in the textbook. The work, they should have put a worksheet in there, but they didn't. I think they're just trying to keep things relatively simple. But where does that leave us? Well, remember, at the end of Chapter 2, we were working with an unadjusted trial balance. Okay. Now, we're going to go from the unadjusted trial balance, and we're going to make adjustments. Okay, remember, because this is the unadjusted trial balance, we're going to make adjustments, which will allow us to create an adjusted trial balance. And from the adjusted trial balance, that will allow us to create an income statement, a balance sheet, make closing entries, and create a post-closing trial balance. Okay. So I'm at 18 minutes, and let me jump all the way back up here. Okay, to give you an idea as to where we're at. And then we'll move on to the next video to keep on keeping on. Right, so we started out at the beginning of the accounting period. We made journal entries, we posted them, we created an unadjusted trial balance. Okay, once we have the unadjusted trial balance, we have to make sure those balances are correct. So in step 4, we're going to make adjusting journal entries. And when we do, we post them to our ledger accounts, and it allows us to create an adjusted trial balance. Okay, and when we have our adjusted trial balance, from the adjusted trial balance, now we create our financial statements. Okay, whereas in Chapter 2, we only did steps 1, 2, and 3, and we immediately went to step 6. That's not how it works. Okay, you actually have to make adjustments and make sure that the balances are absolutely correct, because once the balances are correct, that allows us to make our correct financial statements. And once we have those financial statements, now we have to say, okay, we have to prepare our books for the next accounting period, because remember, whatever our ending balances are at the end of the accounting period become our beginning balances for the next accounting period. Okay, that's circular, right? Goes this way. Beginning goes to the end then becomes the beginning. more transactions, and it just goes around and around and around. So we have to, once we have our financial statements, we have to make closing entries in step 7 in order to be able to prepare our books for the next accounting period. And once we do that, then we can create a post-closing trial balance, which reflect the balances for the beginning balances for the next accounting period. Okay, all right, so that's where we're at in the process. I hope you're following along. Watch the videos again, pause and rewind if you have to. And again, I'm going to just kind of like begin to pick up where we left off. This was to give you an idea as to the whole process of what we're going to be going through for Chapter 3. And beginning in the next video, we're actually going to start getting into more of the detail that has to do with making these adjusting entries and going through the entire closing process. Okay, so I'll see you in the next video.